The invisible tax you pay every time prices change. You didn't vote for it. You can't see it on a receipt. And no politician has to take responsibility for it. Yet it quietly charges you every single day. Not when you buy something, not when you earn something, but when prices move. This is the invisible tax. And once you notice it, you'll never look at money the same way again. Imagine you wake up tomorrow and nothing looks different. Your salary is the same. Your bank balance hasn't changed. Your rent, groceries, subscriptions, all still priced in the same currency. But something has changed. Your money is now worth less. Not because someone stole it, not because you made a bad decision, but because the system quietly shifted underneath you. And here's the uncomfortable truth. Most people lose money before they even realize a price changed. Let's rewind. Think about the last time you noticed something get more expensive. Maybe coffee, maybe rent, maybe eggs. You probably said something like, "Wow, prices are crazy now." But you didn't ask the deeper question. Who gained when that happened? Because every price change does two things at once. It takes purchasing power from one group and gives it to another. That transfer is the tax. To understand it, we need to talk about money like it's a measuring stick. A dollar is supposed to measure value the way a ruler measures length. But imagine if your ruler randomly shrank overnight. Suddenly, the same table looks longer. Not because the table changed, but because your measuring stick did. That's what inflation is. It's not just prices going up, it's your unit of measurement shrinking. And when that happens, anyone holding cash or earning in cash pays the price first. Here's the part no one tells you. Inflation doesn't hit everyone equally. It moves through the economy in waves. Picture a stone dropped into a lake. The first ripples hit the people closest to the center. In the real world, those closest are governments, banks, and large financial institutions. When new money enters the system through stimulus, loans, or central bank programs, it doesn't land in your bank account first. It goes to the top of the financial food chain. Big banks, asset markets, major corporations, government spending. They get to use the money before prices adjust. By the time it reaches workers, savers, and retirees, prices have already moved. You're not just late, you're paying for the early access others enjoyed. Let's make this real. Say the money supply increases, not all at once, not evenly, but slowly through lending and spending. At first, asset prices rise. Stocks, real estate, cryptocurrencies, anything that benefits from cheap money. People who already own assets feel richer. Then wages start rising, but only later and usually not as fast. By the time you notice higher pay, your rent has jumped. Your groceries cost more. Your insurance is higher. Your raise was just catching up to the tax you already paid. This is why people feel poorer even when the economy grows, because growth is measured in money, not in purchasing power. Your salary might go up 5%, but if prices rose 7%, you didn't gain anything. You lost 2%. Silently. No bill, no notification, no explanation. Just a smaller life, disguised as the same one. Now here's the strange irony. Governments don't need to raise taxes to collect this. They just need prices to change. When inflation rises, tax revenues rise automatically. Why? Because you're paying for the same things. Sales taxes increase, income taxes rise as wages adjust, capital gains taxes climb as asset prices inflate. The government collects without changing a single law. That's the invisible tax working perfectly. But the system doesn't stop there, because once people expect prices to rise, behavior changes. Businesses raise prices preemptively. Workers demand higher wages. Investors chase assets faster. Inflation feeds on itself. And every time it accelerates, those holding cash fall behind. Savings lose value. Fixed incomes shrink. Long-term planning becomes guesswork. You start running just to stand still. This is why the phrase "prices are going up" is misleading. Prices don't move on their own, they react to money. And when money changes, power shifts.
from savers to borrowers, from workers to asset owners, from the slow to the fast. It rewards those closest to the flow and punishes those downstream. Here's the quiet part. The invisible tax isn't a bug in the system, it is the system. Modern economies rely on controlled inflation to function, to reduce debt burdens, to encourage spending, to keep the machine moving. But the cost is trust. Trust that your money tomorrow will still mean what it means today. And once that trust erodes, everything changes. People stop saving, they stop planning, they start rushing. Not because they're greedy, but because standing still becomes too expensive. So next time you notice prices change, don't just ask, why is this more expensive? Ask, who got the money first? Who paid last? And how much did the system just take from me without ever asking? Because the invisible tax is always there. You just feel it after it's already done its work. And the real question is this: if money itself keeps changing, what does it really mean to be rich in the first place?